The reversal already happened. By the time the headline said turnaround, price had already reclaimed the level that crushed confidence for months. The red candles that defined the downtrend were gone, replaced by a sharp expansion that caught short sellers off guard. I was awake when it started, not because I expected a breakout, but because something felt off hours before it happened. The order books were unusually quiet. Liquidity above resistance looked thin. Funding rates had flipped negative again, even as price stopped falling. That contradiction matters. Retail was leaning bearish. Social sentiment was heavy. Influencers were warning about another leg down. The mood felt defeated, and then the green candle printed not gradual, not polite, aggressive, liquidation stacked, shorts squeezed, resistance evaporated. What looked like another dead cat bounce turned into a structural reclaim. But here's what unsettled me. The move didn't begin with news, it began with positioning. Hours later, narratives rushed in. Analysts labeled it a major turnaround. Commentators referenced improving regulatory tone and renewed institutional interest around Ripple Labs, but the chart moved before the explanation. That means someone was ready. And when I traced the data back, funding, open interest, on-chain flows, I realized this wasn't a reaction, it was a reset. And if this is truly a confirmed turnaround, then what happened before the breakout is more important than the breakout itself. Let me show you what I found. I remember the day XRP lost key support. The breakdown looked decisive. Volume spiked. Stops were triggered. Analysts called it confirmation of continuation. I almost believed it, but something didn't align. Despite the sharp drop, spot volume wasn't aggressively expanding. Most of the pressure came from derivatives, over-leveraged longs being forced out. That's not organic collapse. That's structural cleansing. I watched funding rates sink deep into negative territory. That meant traders were paying to stay short. Confidence in downside was rising rapidly. And when confidence piles up on one side, risk builds quietly on the other. The breakdown felt convincing, too convincing, and markets punish conviction when it becomes consensus. I started tracking large wallet movements during the consolidation after the drop. Outflows from exchanges increased slightly. Not dramatic, but consistent. Large clusters accumulated during moments of weakness. They weren't chasing strength, they were absorbing fear. That's the difference between smart money and emotional traders. Retail reacts to candles, whales react to positioning. What caught my attention was the timing. The heaviest accumulation occurred when social sentiment hit extreme pessimism. That's rarely coincidence, it's opportunity, and opportunity rarely announces itself loudly. For years, XRP's narrative was shaped by its legal battle with the U.S. Securities and Exchange Commission. Every filing created volatility. But recently, I noticed something subtle. The market stopped overreacting to regulatory updates. Bad news no longer triggered panic. Good news no longer triggered explosive rallies. That neutrality signals something important: risk premium compression. When uncertainty becomes manageable, institutions begin to reassess exposure. They don't need perfection, they need diminishing risk. And diminishing risk changes valuation models quietly before price reflects it dramatically. The night of the breakout, I saw something I hadn't seen in months. Liquidity above resistance was thin. Sell walls that previously capped rallies were gone or significantly reduced. That doesn't happen randomly. Supply either gets absorbed over time or it steps aside. When price pushed upward, it didn't grind, it accelerated. That's what happens when overhead resistance has already been weakened during accumulation. The breakout looked sudden, but structurally it had been prepared. I checked liquidation data immediately after the surge. Short positions were wiped out in waves. The move wasn't fueled by euphoric buying, it was fueled by forced buying. Short squeezes amplify structural reversals because every liquidation adds market buy pressure, accelerating the move beyond what spot demand alone could create. The narrative called it renewed optimism. The mechanics showed something else: positioning imbalance correction. And that's powerful. I compared XRP's move with broader market flows. Capital was rotating back into assets with improving legal clarity and enterprise alignment. XRP fits that profile. When institutions allocate, they don't chase volatility blindly. They prefer assets where structural risk has declined, but sentiment hasn't fully recovered. That's asymmetric. And asymmetric setups don't last long once discovered. The confirmation wasn't emotional, it was structural. The most fascinating part came after the breakout. Retail didn't immediately celebrate. They hesitated. They questioned sustainability. That hesitation is healthy, because explosive euphoria often marks tops. Cautious optimism can mark beginnings. I watched funding normalize gradually instead of spiking aggressively. That means leverage wasn't immediately rebuilding. The move had breathing room, and breathing room sustains trends. When people say turnaround confirmed occurred, they usually mean price reclaimed a key level, a breakout above resistance, a strong daily close, a green candle that looks decisive enough to screenshot and celebrate. But confirmation isn't a candle. A single candle can be emotion, short covering, thin liquidity, a reaction to a headline. It can be reversed just as quickly as it appeared. Real confirmation is deeper. It's a shift in structure. It's when the pattern of lower highs, that slow grind of weakness, finally breaks. Not temporarily, not with a wick, but with conviction and follow through. It's when a ceiling that rejected price for months stops acting like a barrier and starts acting like a floor. Resistance reclaimed as support. That's not hype, that's transition. Then I look at derivatives. Has leverage been flushed? Has funding normalized? Are traders still overcrowded on one side? A true structural turnaround doesn't happen with excessive long euphoria. It happens after pain, after liquidation, after imbalance is cleared. Derivatives reset, then sentiment. When extreme pessimism begins to soften, not flip into mania, but stabilize, that's another layer of confirmation. Markets rarely reverse when everyone is confident. They reverse when confidence is fragile and positioning is light. Sentiment recovering from exhaustion is different from sentiment exploding into greed. That combination is rare. Structure improving, leverage cleansed, sentiment stabilizing, liquidity rebuilding, and rare combinations signal regime shifts, not short-term bounces, not relief rallies, regime shifts, the kind that redefine how the asset behaves for months, sometimes years. That's what real confirmation looks like, not a candle, a foundation quietly rebuilt underneath it. Here's what I've learned watching XRP through cycles. Turnarounds don't reward late certainty. They reward early patience. The market doesn't hand out clear invitations at the bottom. It doesn't ring a bell and announce the downtrend is over. Instead, it shifts quietly, subtly. Structure begins to improve while sentiment is still skeptical. Higher lows form while commentators are still bearish. Liquidity rebuilds while retail is still exhausted. If you wait for universal agreement that the trend has changed, you'll enter alongside the crowd, paying premium prices for emotional comfort. By the time everyone feels safe, the asymmetry is gone, the risk has compressed, the upside has already been partially realized. Certainty is expensive, doubt is discounted. If you study positioning during doubt, funding rates, open interest, exchange flows, support reclamations, you position before confirmation becomes obvious. You act when the risk reward is skewed, not when it feels validated. This move may change everything, but only for those who understand what actually changed. It wasn't the headline that shifted the market. It wasn't the hype cycle restarting. It was the structure beneath it. Lower highs broken, liquidity absorbed, derivatives reset, sentiment transitioning from despair to neutrality. That's the foundation. And foundations matter more than fireworks. If you ignore structure and trade narratives alone, if you let headlines dictate timing, you'll always arrive after the smart money has already settled in, after the accumulation phase, after the reset, after the quiet positioning window has closed. The market rewards preparation during uncertainty, not reaction during clarity.